Most real estate portfolios eventually stagnate, and it rarely happens because the investor can't find good deals. It happens because their liquid cash is depleted, while their equity remains inaccessible. Over a 5-year period, these two paths look very different. On the left, an investor allows equity to accumulate in one property as the loan is paid down. On the right, the investor redeploys that same equity to secure additional cash-flowing assets. We are going to conduct a 5-minute portfolio equity review. This process identifies the specific dollar amount currently sitting in your properties and outlines how to access it without selling your assets. To follow along, you will need your current mortgage statements, a calculator, and a blank piece of paper. Moving equity from a balance sheet into a new acquisition changes the velocity of your portfolio growth. Step 1 is determining the current market value of your property. You can find this by reviewing recent comparable sales in your neighborhood or analyzing local appreciation trends from the last 12 months. Many investors calculate their net worth based on what they originally paid for a property. For this review, strike out that original purchase price and replace it with a conservative estimate of today's market value. Because of market appreciation and monthly principal paydown, the actual equity available is often significantly higher than most owners realize. Step 2 is calculating your total available equity. This formula is simple. Take the current market value of $850,000 and subtract the current loan balance of $400,000. That leaves $450,000 in total equity. Look at the principal balance on your mortgage statement and subtract that exact number from your updated property value. Write this number down. This represents the total wealth currently tied to this specific asset. Step number 3 is calculating your usable equity. Experienced investors do not attempt to extract every dollar of equity from a property. You must maintain a safe cushion to protect against market fluctuations and ensure the property remains self-sustaining. This calculation leaves you with a defined slice of capital that can be safely extracted for new projects. Determine your safe margin, typically 25 to 30% of the total value, and write down your final usable equity number. Step number 4 is identifying the spread. Capital should only be accessed when you have an investment target that produces a higher return than the cost of the new loan. If a cash-out refinance costs 7%, but your next property acquisition is expected to return 12%, you are capturing a 5% spread. This positive spread ensures the cash flow from the new asset covers the debt service of the capital you extracted. Step number 5 is the deployment strategy. Consider an investor with 4 properties and $1.4 million in usable equity. This investor finds an off-market 8-unit property. It is currently under-rented and needs significant renovation to reach its full market value. By tapping their usable equity, they fund this new project without selling their existing rentals. The capital splits into 3 buckets: the acquisition down payment, the renovation budget, and a liquid cash reserve for safety during construction. Look at your own usable equity number and map out how it would fill these 3 buckets for a target property in your market. This strategy allows for the acquisition of new income streams while keeping the original portfolio intact. You now have a mathematical overview of your current portfolio and a roadmap for your next acquisition. A property with 50% equity is often less productive than 2 properties with 25% equity each, provided the cash flow on both assets covers the debt. If you would like a professional review of your math and deployment strategy, you can schedule an investor capital strategy session with us. During that session, we will analyze specific financing structures and help you finalize a plan to secure your next asset. Mastering this review ensures that when a discounted deal appears, you have the liquidity ready to act before the opportunity disappears.